Ladies and gentlemen, good day and welcome to Trustline Holdings Investor Call for PMS Fund. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arun Nagiri, Founder, CEO and Chief Investment Officer. Thank you, and over to you, Mr. Arun Nagiri.
Thank you. Good afternoon to everyone. Welcome to our investor call. Appreciate all of you joining on a working day. Really appreciate that. Thanks a lot. So for those of you who have joined this call for the first time, let me give you a bit of a context for this call. The reason why we do this call primarily is to bring in transparency in our investor communication. We do write our newsletters quarterly. Some of you may have an opportunity to go through it. This call is to build further from there and to provide opportunity for our investors to understand our strategy, our approach, and our view on the market outlook, and also our view on the portfolio performance and the portfolio actionables and portfolio outlook. So that's a kind of a backdrop which I wanted to set in. In terms of structure of the call, it's like as usual what we had done in the earlier calls. Initial 20-25 minutes will be an opening commentary, primarily focused on market view, and followed by highlights on the portfolio actions and portfolio performance for the last quarter. Followed by this, we'll throw the floor open for Q&A for people to ask any questions and clarifications. And that's the plan. So the plan is to, basically wrap up the whole session in 45 minutes to max of 1 hour. So that's the kind of, plan we have. So in terms of markets, the best way to understand what's happening in the market is to rewind and go back and look at what has changed in the last 6 months. That will give a very interesting outlook on the market. So if you go back and look at March quarter, that is Jan, February, March, primarily the narrative was focused on Chinese reopening trade. The FIs saw China growth coming back on reopening, and as a result, they took money out of markets like India, which was relatively outperforming in the year FY20, in the year calendar year 22. So they took money out and then pushed back into China. So as a result, India underperformed in March quarter. Just for, in terms of data point, Nifty and Sensex fell by about 3 to 4%, and small cap index fell by about 8 to 9% in that quarter. Whereas the entire global markets, including Nasdaq and S&P and all, were up in that quarter. That was the setting for March quarter. Come April, things dramatically changed. The Chinese consensus trade on reopening fizzled out because the growth in China started slowing down. Meanwhile, India surprised in terms of GDP number for March quarter. The consensus estimate for March quarter was 5% GDP growth, whereas India delivered 6.1 or 6% GDP. So there was a beat on GDP. That was one. But the surprise is not on the GDP beat. The real surprise was on the internal underlying numbers within the GDP in terms of private investments. The growth for private investments was really stunning in quarter 4. Just to give you a number, in quarter 4, the private investments did about 14 trillion rupees, right? And that was high for any quarters in the recent quarters. For the year as a whole, the private investments did about 25 trillion rupees. And that is well over about 8% of GDP for the entire year. As all of us know, private investment was languishing at about 3 to 4% for the entire decade Now suddenly there is a, kind of a turn in private investments which surprised many who looked at the GDP numbers a lot more in detail. And that set the kind of a tone for the FY24 upgrade for the earning numbers, because the capex turn is very, very crucial, and capex cycle has a lot of multiplier effect for the GDP, right? So that was a big surprise on macro. And, the Indian macro was already strong in terms of, resilient rupee, stable forex reserves, and very attractive growth cycle, and superior external debt, which we have been highlighting call after call. Added to that, now you have a big turn in private investment cycle, plus, very solid comfort in terms of the current account deficit numbers because of surge in service exports, which again we highlighted in many of our communications earlier. So that is one aspect which is on the macro getting stronger and stronger for India. In a global macro, which is weakening because of high interest rates and slowing growth across the developed countries. So that's a kind of a, contrasting setting for India in terms of macro. That is one thing. Second thing which I would like to share is the two important structural trends in terms of technicals. Basically, technicals, what we mean is the inflows into the equity, the financial flows into the equity. The two aspects, the two structural trends which I would like to talk about and focus is on domestic flows and the FI flows. Let me first turn to the domestic flows. There is a very interesting shift happening on the structural shift happening on the domestic flows. So let's look at the number. I'll share one data point, recent data point, which is the equity asset under management for the domestic institutions, right, which includes basically equity, mutual funds, insurance companies, and banks and pension funds. All these four together generally is clubbed as DIIs, which is domestic institutional investors. The equity managed by the DIIs, recent number is about $550 billion. The same number for FIs is just about $30 to $35 billion higher than this. This difference used to be $120 to $140 billion just about 2 years back. That tells you a lot of things what is happening on domestic flows. Basically, domestic flows are, domestic AUM is catching up with the FI AUM. More so with the potential $30 to $40 billion annual flows on the domestic side, which there is a huge visibility for that now. With that kind of flows, it is question of time before the equity AUM from the DIIs is going to far outweigh the FI's equity and basically FI's AUM. So the domestic flows which are giving a huge counterweight for FIs is going to increasingly grow as the months and years pass by. Now, mind you, I think that the household savings in terms of the percentage of household financial savings that go into equity is less than 9% in India. The same number for Western developed countries is about 45%. So there's a lot of headroom for domestic flows to grow exponentially for India. So that is one aspect. Now, there is a second order impact because of the structural shift on the volatility of the equity markets. For example, in the earlier cycles, whenever FIs used to pull out money, the market used to see a very vicious correction. Now, because this structural trend in domestic flows, we no longer see a very deep correction when FIs pull out, as we witnessed in 2022. FIs pull out massive number last year, but the markets went through a very shallow correction. The other aspect of it is when the FIs start coming in, because of this support from domestic flows and the FIs, the combo effect has a huge impact on the overshoot in Indian markets. So you see, like what you are witnessing now in the last 2-3 months, the stable domestic flows and FI flows have turned from negative to positive. That has a huge impact in terms of in terms of making the market more and more expensive. So because of these two impacts, what we are seeing as value investors is more and more it's going to be a challenge for the value investors because you are not going to, no, unless there is a huge global accident. Of course, that can prick the whole thing and the market can go through a very deep and vicious correction. But for that, I think the markets are going to more and more going to see a very shallow correction, even in the event of FIs pull out, which means the vicious cycles during bear market and the virtuous, vicious cycle which you used to see in the bear market is going to be lot less deeper in the coming years because of these massive flows which are happening from the domestic side. So on the flows, I said there are two trends we are witnessing. One is on the domestic flows. Next, we will come to the FI flows. There again, we are witnessing a huge structural shift, which is basically a China reallocation story. Now, we have been highlighting this that, China, if they get about 5.5, if India used to get about $1 from FIs, China used to get about $5.5. That used to be the story earlier. Now, as this reallocation gathers momentum, what we were saying is this 5.5 will probably stagnate around 5 for China, and this 1 will go to 1.5 for India, which is basically a reallocation from China to India. And we have started seeing those early signs now. I'll share one data point from Bloomberg. In the second week of July, India received about $637 million flows from FIs, and 1/3 of that went to China. Of course, this is for a very, very short period of a week, so one cannot extrapolate from this and then see a massive number. At the same time, it does point to a trend. One more data point which is interesting is, in 2 years back in 2020, China's weightage in MSCI used to be around 37-38%. That has now fallen to about 29%. And India used to be at about 8%, which has now all the way gone up to about 14.5%. That tells you a lot. So basically, in summary, what we are saying is, you have a combo effect which is happening on the market, which is one is a stronger macro for India, which is becoming one of the bright spots in the weakening global macro. And supported by these two structural shifts in flows, the market is on a fire because of this combo effect. Of course, this is a challenge for value investors like us because the pipeline is more or less dried up in terms of finding out new opportunities because the market has become very expensive and it is overshooting. In this kind of markets, how we deal, what do we do in terms of our approach to stock-specific action? Use the strong rally. I've just listed out some of the actionables, what we manage to deal with this kind of very, I would say very strong momentum-oriented market is this. Use the strong rally to exit from weaker positions. Stock-specific pruning in high-weight allocations to raise cash level. We are looking at raising cash levels to close to about 15% plus if the markets continue to surge, leading to overshoot in our positions, especially ahead of results announcement in underlying portfolio positions. Stay on with quality positions even if the weights keep going up, given the very strong medium to long-term outlook for the markets on attractive India story. So that's the overall summary on the markets. Now let me turn my attention to the portfolio highlights. In the last quarter, June quarter, our fund delivered close to about 18.5% return vis-a-vis BSE 500, which delivered 13.18. And small cap index, of course, we have marginally underperformed for the quarter because small cap index did close to 21% in that quarter. But that is a quarterly, very short-term kind of performance. But if you extend the horizon to 6 months and 1 year, our fund delivered close to about 40% for the last year, 12-month trailing period, vis-a-vis 30% for small cap and about 23% for BSE 500. That's the overall returns in terms of fund level. This is, of course, client to client. It will vary based on their entry and exit times. And this is at a aggregate fund level returns measured by TWRR, post all expenses.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Arun Nagiri for closing comments. Over to you, sir.
Thanks a lot for the patient audience. Really appreciate taking time off on a working day and to join this call. Thanks a lot for the participation. We do this call every 6 months, so the next one will be after the next 6 months. Look forward to joining that call. Thanks a lot. Thank you.